$5.9 trillion is about to move through the American economy. That's not a typo, it's the combined spending and tax cuts packed into a single bill. Some call it stimulus. Others call it a debt bomb. What it really is opportunity. Because if you understand where this money will land, you can position yourself to benefit. And if you don't, you risk falling behind while others get ahead. This isn't theory, it's already in motion. At the same time, inflation is proving stubborn. Growth is slowing. The word stagflation is coming back into headlines. It's not the 1970s all over again, but there are lessons from that era that still apply. We're also in the middle of a massive technological shift. Artificial intelligence is being adopted at record speed, and not just by tech companies, by banks, manufacturers, and defense giants. When you combine historic levels of corporate investment, persistent inflation, and a new wave of AI adoption, you get a market environment unlike anything we've seen in decades. The next 3 years will be shaped by how businesses respond and by how you position yourself. In this breakdown, we'll look at what stagflation means today, which industries stand to gain from the $5.9 trillion injection, how AI is becoming a profit protection strategy, and where smart money is moving right now. This is about building wealth while others hesitate. This is about taking the passive path to long-term growth without chasing every market swing. Stay with this to the end, because the way money moves from here will decide who's ahead in 2028 and who's not even in the race. Stagflation is when low economic growth, high inflation, and high unemployment all happen at the same time. It's one of the toughest combinations for any economy. The last time it hit hard in the United States was in the 1970s. Gas lines stretched for blocks, prices rose faster than wages, jobs were scarce, but today's environment is different. The Federal Reserve has learned from past mistakes. Instead of rushing to cut interest rates at the first sign of trouble, it's holding steady to keep inflation from getting out of control. The government is also taking a more business-focused approach with tax incentives and investment programs designed to keep companies hiring and spending, and there's a powerful new factor in the mix: technology. In the 1970s, there was no AI to help companies cut costs or protect profit margins. Today, businesses can invest in tools that boost productivity even when the economy slows. That doesn't mean there's no risk. Persistent inflation means the cost of living stays high. Slower growth means fewer opportunities for wage increases. For investors, it creates a puzzle. How do you protect your money when prices keep rising but the economy isn't booming? The answer lies in knowing which sectors can still grow, even when growth is hard to find. Some companies will use this environment to take market share from weaker competitors. Others will use it to make strategic investments that pay off long after inflation cools. This isn't about waiting for the perfect economy, it's about finding the moves that work in the economy we have now. The $5.9 trillion package combines massive tax cuts with new spending. It's designed to push investment into American companies and industries. For corporations, the incentives are clear: generous deductions for equipment, expanded credits for research and development, special benefits for small business investors. With profit margins already high in many sectors, companies now have even more reason to reinvest their cash. That could mean new factories, new technology, and new hiring. It could also mean more mergers, acquisitions, and expansion into untapped markets. But there's a cost. The bill is projected to add over $5 trillion to the national debt in the next decade. That level of borrowing could put pressure on interest rates in the future, and it could make the economy more vulnerable if growth slows again. In the short term, the incentives will likely boost business spending. In the long term, the challenge will be paying for it. For investors, the question is how to position for both outcomes. You can benefit from the wave of investment in the next few years, and you can prepare for the possibility of tighter conditions later. The money is coming. The choice is whether to be on the receiving end of it euro or watch it pass you by. Corporate profit margins in the United States are near historic highs. Strong margins mean companies have extra room to protect earnings when the economy slows. One of the fastest growing strategies to do that is investing in artificial intelligence. AI can automate repetitive tasks. It can speed up decision making. It can reduce labor costs without cutting quality. For investors, this matters because AI can help companies maintain or even grow profits in a low-growth economy. But there's a limit. The last time a new technology wave hit, like the fiber optic boom of the late 1990s, too much was built too fast. It took decades for demand to catch up. That risk is real for AI. The winners won't just be the companies selling AI systems. The winners will also be the businesses that adopt AI early and use it to improve productivity before their competitors. Large banks with the capital to integrate AI quickly could see big efficiency gains. Industrial leaders could use AI to optimize supply chains and reduce downtime. Defense contractors could use it to speed up design and testing. AI is not a guarantee of higher profits. But in a market where every fraction of a percentage point in margin matters, it can be a deciding factor. The companies that use AI effectively will be in a stronger position to weather slow growth and sticky inflation. The economy in the next few years will move in two stages. The first stage runs from now through 2028. Corporate investment is likely to remain strong. Tax incentives will keep capital flowing into equipment, technology, and expansion. Interest rates may stay high enough to control inflation, but low enough for companies to borrow when needed. This is the period to look for industries positioned to grow with that investment wave. Big banks and large-cap finance firms with resources to deploy AI at scale. Industrial and defense companies benefiting from long-term contracts and tax advantages. Private software firms that qualify for small business tax breaks and can scale quickly. The second stage begins after 2028. Debt levels will be much higher. Interest payments could take a large share of the federal budget. Policy changes could shift priorities away from aggressive corporate incentives. In this stage, investments that rely too heavily on government support may lose momentum. Sectors with strong global demand and self-sustaining growth will be safer. Positioning now means preparing for both stages. Build exposure to the industries riding today's investment boom. Balance it with assets that can hold value when conditions tighten. The market is giving a clear window of opportunity. The challenge is using that window before it closes. Interest rates are the lever the Federal Reserve uses to balance growth and inflation. When inflation is high, the Fed raises rates to slow spending. When growth slows too much, it lowers rates to encourage borrowing and investment. The challenge now is that inflation has shifted between services and goods, making it more persistent. If both rise at the same time, the Fed faces a harder choice. Lowering rates too quickly could push inflation higher. Keeping rates high for too long could slow growth even further. A steep yield curve could develop if short-term rates drop while long-term rates rise. That would push the cost of borrowing for businesses and consumers higher over time. The strength of the US dollar is also tied to interest rate policy. A strong dollar attracts foreign investment and helps keep import prices stable. Mixed signals between fiscal and monetary policy can weaken confidence in the currency. For investors, interest rate changes can reprice entire markets in days. Being prepared means knowing which assets benefit from lower rates and which are more resilient when rates rise. Rate shifts will happen. The key is being ready before they do. Some investments build wealth slowly and steadily. Others aim for rapid growth with higher risk. Dividend-rich industrial companies and defense contractors offer steady cash flow. They can handle a variety of economic conditions without losing momentum. They benefit from long-term contracts, established markets, and consistent demand. On the other side are high-growth, high-volatility plays. These include disruptive tech, emerging industries, and some crypto assets. They can move sharply higher in the right conditions. They can also drop quickly when sentiment changes. Both approaches can work. The difference is timing and balance. In uncertain markets, leaning towards steady cash generators can preserve capital. When conditions improve, adding selective high-growth exposure can accelerate returns. The best portfolios use both. They adjust the mix based on where the economy is in the cycle. This way, you capture opportunity without exposing yourself to unnecessary risk. The number of public companies in the United States has fallen sharply in the past few decades. In the 1990s, there were around 9,000. Today, there are closer to 3,000 in major indexes. This limits the options for investors who want to own shares in a wide variety of businesses. Tokenization offers a new path. It allows assets to be divided into digital tokens that can be traded more easily. This could open access to investments that are not currently available on public markets. It could also make it cheaper and faster for companies to raise capital without going through the traditional public offering process. Stablecoins are another development to watch. They make it possible to move money quickly and with lower transaction costs. Large corporations and even major retailers are exploring how to integrate them. Over time, a combination of tokenization and stablecoins could reshape how investments are bought and sold. It could expand the range of opportunities for individual investors. Change will not happen overnight, but the direction is clear. The structure of the investing world is beginning to shift. Here are 3 key moves to prepare for the economy ahead. First, position part of your portfolio in companies using AI to protect and grow margins. Focus on large firms with the resources to deploy it effectively. Second, target sectors benefiting from new tax incentives. Industrials, defense, and qualified small business investments have structural advantages in the current environment. Third, keep a portion of your portfolio in cash or short-term assets. This allows you to move quickly when interest rates shift or new opportunities appear. Avoid overcommitting to any single theme. Balance investments that can grow now with those that can hold value if conditions tighten later. Use the next few years to strengthen your position rather than chase every market move. This is how you build wealth on a steady foundation. The passive path is about making deliberate, well-timed decisions. It's about letting your money work without constant trading or unnecessary risk. Like and subscribe to stay ahead of the trends shaping your financial future. Share your thoughts in the comments on where you see the best opportunities. The tools, incentives, and changes are already here. It's time to use them to your advantage. Comment below with your thoughts on where the best opportunities are right now. Share this with someone you care about so they can prepare too. I wish you the best of luck in your investing journey. Feel free to explore other videos on the channel for more strategies and perspectives. See you in the next video.